Hi everybody, welcome back. This week is part 3 of our series of tax basics. So week 1 was deciphering a pay stub. Last week was looking at the structure of a tax return, what gets reported and what that process looks like. Today we're going to look at how tax is calculated, how the brackets work, how to adjust your withholding to achieve the refund or balance due that you would like for the tax year. And then next week we're going to come back and do Q&A. So if you have questions over these last few videos, please be sure to get them in over the next few days so that I can get your question answered in next week's video. So before we get too far, you might want to have a current pay stub handy, and also there's a link in the description below to a Google Sheet that you may click on, save a copy, and use, and we're going to use that in the video today. So you might want to pause and get those two things handy before we move forward. So we'll jump into the tax brackets. So one of the biggest misconceptions that I hear is that if I make a little bit more money, all of my money will be taxed higher. I'll fall off of a cliff and have a much higher tax bill. And that's not how our tax brackets work. So let's take a look at that. In the spreadsheet that's linked in the description, one of the tabs is calculating the tax bill. This is a tab that you should not edit or modify, but it's a good illustration for our purposes here. So if you remember back to a previous week, we talked about your standard deduction, that you don't pay tax on that first $13,000, $14,000 at all. Beyond that standard deduction, or itemized if you're able to do that, when you're single, the first $11,000 of your income is taxed at 10%. Always. Doesn't matter how much you make. That first $11,000 is taxed at 10%. The next $30,000 or so is taxed at 12%. The next $60,000 or so is taxed at 22%. So yes, when you make additional money, that additional money is taxed at a higher rate, but those initial dollars are always taxed at those lower rates. So making a little bit more isn't going to cost you a fortune. There isn't a point for most people where making an extra dollar is going to increase your tax bill. Could be different if you collect Social Security benefits, but in most cases, this is not an issue. So one other thing to note is that if you have capital gains, so you had stock transactions, you owned stock in a company for more than a year, and when you sold it at a profit, those long-term capital gains are taxed at lower rates. So if you're in those first two tax brackets, the 10 or 12% tax brackets, those long-term capital gains are taxed at 0. Above that, you're generally going to be taxed at 15%. The maximum that could be taxed is 23.8, but your income has to be much higher to get to that. Another question that we get has to do with bonuses. Are my bonuses taxed higher? And there are two pieces to that question. One is that your bonus is part of your income. Your total income goes on your tax return, and so it's taxed exactly the same as any other income. Whatever your tax rate is for the year is what your bonus is going to be taxed at. The reason this comes up as a question is because when you receive a bonus, your employer may withhold a flat 23%, or they may add it to your other income, and your withholding on that particular check may be a higher percentage just because of the way that the IRS tax tables are calculated, the way that they're structured. So you may have a higher percentage of withholding on that bonus, but when it comes down to tax time and we calculate out what your tax bill is, the percentage is going to be the same as any other income. So let's look again at how the tax return is structured, and we're going to pull out that pay stub that you set aside. So if we go to the main tab of this spreadsheet, The first thing that it asks you for is the date of the pay stub that you have. So if I put that I just got a pay stub on February 2nd, and I'm paid every other week, it's important to choose the right pay frequency. If you're paid weekly, every other week, twice a month, or monthly, it's going to calculate how many more pay stubs you should receive over the course of the year. This calculator works pretty well if you're paid around the same every pay period. If your pay fluctuates wildly throughout the year, it's something that you'd probably want to do this estimate more frequently. If your pay is pretty stable all year, you do this math once and you're probably fine. Maybe check it again in the fall. So the next part is to pull information from this particular pay stub. So in this case, we're going to use an example and say, my gross pay, the amount in the gross pay line on this check is $1,350. It's doing a bunch of math. If you had some pre-tax line items on your pay stub, you're contributing to the regular 401k, or you've got some pre-tax health insurance premiums, something like that, you can enter those here and it will bring down your taxable wages. Some pay stubs are great and they tell you what your taxable federal wages are, in which case you can just use that number and don't try to figure it out. That's all fine. The federal withholding for this amount, if you just filled out your W-4 to say single and marked nothing else, is $85.74. And so it's calculating, okay, if you make $1,350 per pay period and there are 23 more pay periods left, your pay for the year is going to be about $31,000, and this is your withholding. But wait, we've already received a couple of paychecks in January, so we need to include that year-to-date information, which should also be on your pay stub. So year-to-date, this person would have received $2,700 and had withholding $171.48. So now we have a picture that if this person's income was steady throughout the whole year, the withholding stayed stable, they would have a W-2 at the end of the year next year, January of next year, of $33,750 and withholding of $21,435.50. The IRS really doesn't care about pennies, but I included it because the calculator did. If you have multiple jobs, remember that all income goes on a tax return. So if you have multiple jobs, you may need a couple of these spreadsheets to figure out, okay, for this job, this is what my W-2 would look like, and for this job, this is what my W-2 would look like. If you add in additional wages, it will add into this calculation. If you left a job, make sure to include that information. So then we calculate the tax. So we've got your taxable wages that we just calculated above. We're going to add in any other income. So if you have interest income from a bank account, if you have stock transactions, or you sold crypto, or you received gambling winnings, or any number of other income kinds of things, you can drop in a number here and it will add into your income. The next one is gig work, a 1099 income, independent contractor, freelance. All of these words mean the same thing for tax purposes. They mean that you have some self-employment income. Self-employment income is something that you are earning, so you are doing something to earn this money, and you may receive a 1099 instead of a W-2 for it. You are responsible for your own taxes on this money. So if you remember our Deciphering Paystub week, we talked about Social Security and Medicare tax, where you are paying in 7.65% of your income to Social Security and Medicare for future benefits, and your employer is matching the other half. When you're self-employed, you are paying both. So you're paying 15.3% on the profit of your 1099 work. One thing to note is that you are able to take a tax deduction from that income for expenses. So if you are a Uber driver, then you may be taking a deduction based on the mileage that you drove as an Uber driver. If you do content creation and earn money on YouTube or Twitch or TikTok, you may be able to deduct some of the expenses related to that income, things that you had to spend, your Adobe subscription, those kinds of things, in order to earn that income. So we're going to put in just $100 here, but just know a couple of things about gig work and this spreadsheet. This spreadsheet is highly simplified. It's just to give you an idea. There are deductions related to that gig work income that are not accounted for in this spreadsheet. So if this spreadsheet says that you're going to owe this much, by the time you get those deductions in, that should come down. It should be a conservative number. And I would rather give you a spreadsheet that's giving you a conservative number, that when you do your tax return it comes out better, than have it be the other direction. So just a note on that. So in this particular instance, we took total wages from above. We added a little bit of interest, a little bit of self-employment income to come up with total income. Once we had total income, we take a deduction for your standard deduction for being single in 2024, $14,600. Goes up a bit every year. So our tax is being based on $19,260. This is what goes back to that other spreadsheet, the other tab, which says, again, 10% tax on that first $11,000 in income, 12% on the amount over that $11,600. So in this case, there's a bit at 10%, a bit at 12%. There's not enough income to kick up into higher brackets. So estimated, we've got estimated tax and estimated self-employment tax, that's Social Security, Medicare. So we expect for the whole year that this person's tax is going to be about $2,100. We're also expecting that their withholding based on their pay stub will be about $2,144. So they should, in theory, just about break even with the IRS at tax time. They should get back about $50. If that number is red, it means you may owe at tax time and you may want to make changes. So we're going to go back to that $50 for now. So how do you feel about the number that you came down to? If you're at break even, but you would really like to get a refund, like get a $1,000 refund, then you can do that. You make changes to your W-4 to have additional withholding come out. And then your employer will take more out of each check. It goes to the IRS and it increases your refund at tax time next year. If you're happy with break even, that's great. You will hear some people say, don't plan for a refund. That just means that you are letting the IRS borrow your money interest-free for the year. And that's true. But at the same time, the forced savings of it and getting a chunk of a refund back can be really beneficial for some people depending on their budgeting style. It also allows you to have some of a buffer if you do have some unexpected additional income throughout the year. So I don't think it's entirely bad to plan for a refund. So on your W-4, you marked single. Presumably in this series we've been assuming that you're single. If you had marked married, you can increase withholding by changing to single, even if you are indeed married. And one note on that, if you are married, remember that all of your joint income is going to be added together. You'll have a higher standard deduction in different tax tables, so this particular spreadsheet won't quite work for you. But just know it all gets added together. There is an opportunity to file separately, but depending on what state you're in, that may or may not make sense. If you are already filing single on your W-4 and you want more withholding, there's a checkbox on line 2C that says something about you have multiple jobs. Doesn't matter if you actually have multiple jobs. It's just a way to get the withholding tables to have more taken out of each check. So that's one thing that you can try. In this particular instance that we looked at here, if this person marked that 2C checkbox to increase their withholding per check would have been $140.18. So an extra $50 per check. And if that was consistent through the rest of the year, that brings their refund up to $1,300 for the year. So that one little difference can make a difference. Remember, in that instance, you are now $50 per paycheck poorer in your monthly budget. But again, it's building up this refund for tax time next year. Hopefully that makes sense. The other thing that you can do, if you're already marked single and you've already marked the checkbox for 2C and it's still not enough withholding because you have more gig work or something, there's also a line that says extra withholding on the W-4, and you can outright put a number on that extra withholding number on that line, and the employer will take out that additional amount each paycheck. So that's an option as well. There's also always the option to send money to the IRS. So if you are predominantly self-employed, so if you don't have an employer taking your withholding out and you just have a number on this gig work line, then it's your responsibility to send the IRS money. They like to receive money on quarterly estimated payment dates, April 15th, June 15th, September 15th, and January 15th. And that's not a mistake. January 15th, 2025, you would be making your estimated payment, fourth quarter estimated payment for 2024's taxes. Those are just estimates. It's throwing essentially this withholding at the IRS, and then at tax time it all gets trued up and you find out if you owed or were due a refund. Hopefully that helps a little bit. I may have just created more questions than answers, and if that is the case, please do send them in. I would love to get those questions included in the Q&A video next week. So again, I hope this has been helpful. I hope you have a wonderful week, and I look forward to seeing you again next week.